Hey guys.
Welcome everyone.
Deni,
Absolutely.
last week we talked all about the move out procedure and how to cover your ass as a landlord and make sure that you
Whoa.
don't lose that security deposit.
You would think he has a baby, he wouldn't say that word.
Oh, if anything, with a baby, it's nothing but, body functions and all that stuff all over the place all the time.
That is true. That is true. Well, this
So,
week we're going to go over down payment hacks and how to invest with less. And that's a good subject because let's face it, especially now, we may not always have what we used to.
yeah. I mean, full-blown recession going on in the US and most of the world. So, a lot of investors see an opportunity right now to invest, but don't necessarily have as much cash to invest since, there's just less money floating around in general out there. A lot of people are unemployed and, people are not spending as much, which is dampening the economy and, and so on and so forth. I mean, the trickle down effect. So,
Right.
yeah, so let's talk some down payment hacks, how to invest in rental properties with less of your own cash.
So let's open up with the first owner-occupied homeowner financing, which is interesting because I remember this was probably popular right after maybe the bubble burst because they were all over the place. But you don't see them too much now, but I think that they will make a comeback. Why don't you tell us a little bit about that?
Sure. So if you go out and get a traditional real estate investor mortgage for a rental property, you're probably looking at putting down at least 20%, right, as a down payment. Now, homeowners can put down a lot less than that, right? So the trick for a lot of real estate investors is figuring out how to invest in rental properties by using owner-occupied financing, like homeowner mortgages. Now, there are a few ways of doing this, a few loopholes that you can use. So the first is to move into the property for 1 year and then move out and keep the property as a rental when you move out of it.
Nice.
So yeah, we've known some people to do this, like the Hoflers built their portfolio doing this with multifamily properties, and we'll talk more about multifamily properties in a minute. But as long as you live in the property for at least 1 year, you can use homeowner financing and you qualify for that much lower down payment. So to give you a sense of just how much lower that down payment is, FHA loans, you're looking at 3.5% down if your credit score is over 580. There are some Fannie Mae and Freddie Mac loan programs with as little as 3% down. They're relatively recent. They came out within the last year or two. So, and again, those are for people with better credit, more so than the FHA loans. But yeah, I mean, if you have strong credit and steady income, you can get homeowner financing for 3% down, maybe 3.5% down, which is a far cry from 20 or 25% down that you're looking at with traditional rental property mortgages, investment loans. So if you are willing to move in for 1 year, that's one way of doing it. And then you keep the property as a rental when you move out after 1 year. So as we mentioned a second ago, you can also buy multifamily properties this way. Up to 4 units is what you can buy with a homeowner mortgage. So some people combine those, like the Hoflers went out and they would buy 4-unit properties, live in one of the units for 1 year, and then go out and buy another 4-unit property and move into that for a year. And each time they do it, they keep building their portfolio, 4 doors at a time. So it worked out great. And, there are some limitations with this that we'll talk about in a second, but which they were able to get around. But it's a great way to build your portfolio with very low cash of your own involved, and with lower interest rates too. Homeowner mortgages have charged lower interest rates and less points than investment property loans, because when borrowers get in trouble, they default on their investment property loans long before they default on their home loan. So that's why the down payments are lower for homeowner loans. That's why the interest rates are lower. That's why the points are lower. There's just less risk for the lender.
And that's kind of what we did where I'm currently at right now. We went
Yeah,
in
you live in
with,
a multifamily.
hmm yep, it works out well, along with, some other things. The name of the game is to buy with the least amount down and the least amount mortgage monthly.
That's right. That's right. Keep that cash flow moving. And we'll talk more about cash flow in a few minutes. But one other way, and this is a lesser known way that some people can use owner-occupied mortgages to buy investment properties, is to house hack through their children, through their young adult children. You can get something called a kiddie condo loan, where you go in on a property with a child, and they move into the property. You don't have to move into the property. So your child actually fills the occupancy requirement. So as long as your child moves in for at least 1 year, you're good to go, and you can get that owner occupied financing for it. So it's another good way to
Now,
build
is
your
this for
portfolio with homeowner loans.
single family and duplex, or is it only one type of?
No, yeah, you can up to 4 units. You
Okay.
can get those for up to 4 units. So your child can move into 1 unit or into one bedroom in 1 unit, and you can rent out the rest and the
Wow,
cash flow.
that's very cool.
Yeah, so some investors do that if they have like college aged kids, or if they have kids that are just out of college or in grad school. It's a good age, when your kids are in your 20s, to do one of these kiddie condo house hacking loans.
Hmm. Learned
And
something
as
new
you guys
every
join
day.
us, yeah. So yeah, let us know as you guys join us what some of your tactics have been to pick up some properties with a minimum down payment, because we're always looking to hear what you guys are doing on the ground.
Absolutely. So, Brian, what are some other modes of financing and other ways that people can do this with less money down?
Sure. So with homeowner loans, you cannot borrow the down payment. Those are in the rules. That's written in stone. You can't borrow the down payment. Now, with many investment property mortgages, the lenders do allow you to borrow the down payment, because they tend to invest. They're lending you money more based on the collateral, the property itself, rather than you as the borrower. So many of them do allow you to borrow the down payment. So you can use a traditional rental property mortgage or investment property loan. And by the way, we'll add a link to where you guys can compare some of those and some of their loan terms. But you can take out that to cover like 80% or so of the purchase price, and then for the remaining 20%, you can borrow it elsewhere. At least your lender for your first mortgage will allow you to borrow the rest of the down payment from elsewhere. So one place you can get that is through credit cards, and particularly business credit cards. So we have been working with a company called Fund and Grow, and they help real estate investors take out between $100,000 and $250,000 in combined unsecured business credit cards and rotating lines of credit that you can then use to put towards down payments, or to buy properties outright, or for renovation costs or any other expenses that you have as a landlord or as a real estate investor. And they will show you how to avoid paying cash advance fees on that, how to charge money directly from the title company when you purchase to your business credit cards. And again, these are unsecured. So you don't have to have a lien attached to a property or to a car or anything like that. These are unsecured business credit cards. And
And they literally walk, from what I'm hearing, and I've talked to some people that have been using them that they've heard of it from us, and they literally walk you through the
they'll show you
process.
exactly how to do it. Yeah. They do several rounds of financing or fundraising over the course of a year, and they scrub your credit in between each round of fundraising. So yeah, it works great. I mean, these are basically credit lines you can just draw on as you need, and then pay off as you need, like credit cards. So now, another way that you can go about this, if you don't want to use business credit cards, you can use HELOCs. HELOCs are not as good as unsecured business credit cards for this, because you have to get a lien against a property. which means you have to go through all the title work and you have a bunch of closing costs and a settlement. So it costs thousands of dollars to settle to get a HELOC.
It's also not as easy to get a HELOC on a rental property.
Right. So you can do it. There are lenders that will give you a HELOC against rental properties, but they will not give you as high of a LTV. Like they won't give you as high of a percentage of the property's value as if it were your own home. And the other problem with HELOCs is that they are not indefinite. So most HELOCs, they'll have a draw period, which is usually 5 or 10 years, in which you can draw on the line of credit and pay it back, at your own pace, just like a credit card. But then it will switch over to a repayment period, and it will basically become like a fixed mortgage where you just make fixed monthly payments every month until it's paid off. So you get a few years out of a HELOC, but it's not indefinite the way that a credit card is. It's just a pure rotating line of credit.
Right.
So HELOCs do work. They can be very effective. They're not as good as unsecured business credit cards, but they do work for this, for borrowing the down payment if you like. Now you can also borrow the down payment from the seller and negotiate a seller-held second mortgage, right? Not all sellers are amenable to this, but some are. So that is another option. And lastly, you can use the BRRRR method, which Deni, you and I talk about somewhat frequently. Yeah, so with the BRRRR method, you still need cash to put down as a down payment when you buy the property. But when you're finished the renovations, you can then go back and pull that down payment back out. So the BRRRR method stands for buy, renovate, rent, refinance, repeat. So you buy a fixer-upper, you renovate it to create equity in it, and then you refinance the property. And when you refinance, your loan is based on the new value, the after repair value of that property. So you can pull out the cash that you had tied up in it originally as your down payment to pull it back out and then go out and reuse that cash somewhere else, to buy a new property,
right,
or whatever. So you still need cash, right? I mean, you still need the down payment, but you can get the down payment back after you finish the property renovations with the BRRRR method.
Now, what about going in with family or friends, partners, and pooling money together?
Sure, you can do that. It helps if you know what you're doing.
Yeah.
And the last thing you want to do is risk your loved one's cash on your first rental property deal, or even your second or third rental property deal. That's really, you can't, well, if it's a true 50-50 partnership, that's one thing. But if you're just raising money from them, you got to be careful with their cash. And it helps to establish a track record of success before you even talk to friends and family about partnering with you on deals. So something to keep in mind.
And what are things that you got to be careful of besides that, what you just told us?
Well, here's the thing. We get people asking us all the time, hey, I've got like a couple grand. I want to go out and buy a bunch of rental properties. How do I do it? And Deni and I kind of sit there and be like, well, I mean, you can use these techniques to reduce the cash that you need to invest in rental properties. But just because you can doesn't mean that you should. I mean, down payments really exist for a reason, and not just to protect the lender, but it also protects you from over leveraging yourself and from getting in a situation where you have negative cash flow on a property and you're losing money every year on the property rather than earning money. So many new investors, again, this is something else we talk about quite a bit, is calculating your rental cash flow, and how new investors almost always get it wrong because they underestimate their expenses, especially the expenses that don't hit every month, things like repairs and maintenance, vacancy rate. So new investors are just notorious for going into deals a little starry-eyed and underestimating expenses. And if you go into a deal over leveraging yourself, having very little of your own cash in the deal and just borrowing all the money, you are likely to end up with negative cash flow. So
especially,
we do recommend.
I see I see a lot of it with flips. Like somebody sees a really inexpensive property, they're going to just get in there and do the work and then flip it and make money. But they forgot to take a whole bunch of things into consideration, and it was their first flip. So there's always problems.
Right, exactly. So yeah, we recommend that you do put down a solid 20% when you buy an investment property. And as always, run the numbers in our cash flow calculator to make sure that you have a clear sense of what the cash flow will actually look like, and to make sure that you include all of those irregular expenses that still add up to a lot of money at the end of each year.
Right.
So.
And Tim Dooley said, that's the direction I'm going in, refinance and recoup my costs.
There you go, Tim. There you go. So, yeah, Deni, anything else you want to bring up before we wrap up our conversation about down payment hacks?
I don't think so. I think you've covered it pretty thoroughly.
All right. Well, we added some links there to where you can compare rental property loans and get a sense for the different down payments needed and interest rates charged. And we also added a link to where you can look at a few more down payment hacks to reduce how much you have to come up with at the table.
It is worth noting that a lot of your FHAs and whatnot their credit requirements are higher than the 680 currently. Hopefully that'll, or was it?
FHA.
No, sorry, 580.
Not FHA.
It used to be 580 FHA, but now it's 620.
Right. So lenders have definitely tightened up over the last couple of months with the pandemic. So it is a tighter credit environment right now than it is normally. So just something to keep in mind as you go out and look for financing. On that note, send us the questions or topics that you want to hear about in the future. And we'll see you guys next Tuesday, 2 o'clock Eastern, 11 a.m. Pacific. Have a great week.